Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We are going to be talking about performance measurement and responsibility accounting, which really talks in depth about the performance of the company as a whole from a perspective of different departments, from a perspective of different cost centers, profit centers, investment centers, etc. And it's really designed to help you to analyze the company's performance with respect to all of these different ways of looking at the company's performance. But before we jump into today's discussion, I do want to quickly recap where we are, where we're heading, and where we were. So if we jump into the classroom real quick, so as you know, all the content area, we are currently in Module 3, Week 6. Oh my goodness, of an 8-week course. Oh, what's that mean? Oh, we're going so fast. Okay, last week, you should have done it on time, submitted your Chapter 22 homework assignment and your Chapter 23 quiz. Here's why being on time is so important. We're in Week 6. Week 6, it looks short, and it kind of is, but the homework is busy. Okay. We only have this one chapter that we're going to go over today, but with this one chapter, there's also a relatively lengthy homework assignment. It's really not that bad, honestly, but some of you might think it is. Here's why, because there's writing involved. The homework assignment for this week is very detailed. It says essay questions. That's different. For the most part, you all have dealt with homework assignments, quizzes, and one discussion board for this course. This fourth type of homework assignment is called essay questions. It sounds worse than it actually is. So if you open up the homework assignment that is due this Sunday night, by the way, as it always is, there's 5 questions, just like always. But here's the difference. They're open-ended questions. These 5 questions are asking you very specifically to respond to those questions. Here's the good news. The good news is you can answer these questions very short. Couple short sentences, 2-3 sentences a piece. Boom, done. Easy. Okay. It's asking what the first question, for example, what is a profit center and how is its performance evaluated? You'll be able to quickly find out after today's lecture. Each question is worth 2 points. There are 5 questions. They're all short answer questions. Short answer meaning a sentence or 2, maybe 3, depending on how long you want to answer the question, right? They're open-ended. What does that mean? Well, if you read through the PowerPoint presentation, review today's lecture, if you go and read the textbook, you will be able to answer these 5 questions in about 1, 2, 3 sentences each. And there you have it. And as long as you answer it correctly, you'll be able to get 2 points for each question. If there's 5 questions and it's worth 2 points apiece, by doing some very simple math here, that means the whole assignment is worth 10 points. Now, this is where it gets important for you to understand. This assignment is worth 10 points. Okay? You must do this assignment if you expect to earn a full letter grade. Okay? 10 points. 10 points is a full letter grade in this course, as you know. Each homework assignment and each quiz was worth 5 points each. The discussion board that we did early on, I think it was like the first week, if I'm not mistaken, that was worth 10 points. Or 5, 10, something like that. This is worth 10 points. 10 points is a lot of points. That's a full letter grade. So, my recommendation is to do this homework assignment, these short response questions. And again, all I'm looking for here, 1, 2, 3 sentences for each one. Nice and easy. And honestly, you can easily find the answer to these questions in the textbook, in the PowerPoint presentation, and in today's lecture. So, I strongly advise you to complete this week's homework assignment on time and as successfully as you can. Any questions about this week's homework assignment? Answering these 5 short questions with a few sentences. Any questions at all about this? It's different, it's a little different than a discussion board because it's not a discussion board. It's just a matter of answering these 5 questions. And if you answer these 5 questions, you do it correctly, that's a full letter grade.
Just one question, Professor.
Pavle, yes, please.
Sorry for the noise first. And the second is, do we need because recently I had something similar and I get negative points because it was not like a letter case, it was not correctly like grammarly or something was not grammarly. It was not saying like in a books. Like, can we answer our own words or need to be like exact answer like is in a book?
It should be in your own words. Good question. So try to. Honestly, I'm not going to dock points if it's similar to the book. If you're going to write it similar to the book, please make sure you do the citation and reference. Okay. If you're going to do similar to the book, citation and reference, please. Otherwise, my recommendation is to write it in your own words. Good question. Does it make sense? Everyone understands what you need to do for this assignment?
Yes, Professor.
Great, thank you. Awesome. Cool. So yes, please do it. It's worth 10 points. Okay. Okay, so I'll get off that one. That's due this Sunday night. Again, a few short sentences for each of those 5 questions. You'll be all right, I promise. Just do it. Make sure you do it. Yeah, very, very important that you do it. So that's this week. Last week you had your homework assignment and quiz. If for whatever reason you're like a day behind, I know some of you are a little late on getting that done on time, get it in. Get it in like, now or the next day or so. Because your grade is negatively impacted by missing work. I said very early on, the only way you'll pass this class is by doing the work. And you've had me, but most of you have had me for other courses. And you know that if you don't do the work, you don't pass. It's really that easy. It's really that easy. So do the work and you'll be fine. Now, just before we jump into today's lecture, which we're going to do here in a minute, I also want to point out next week, which is the beginning of Module 4, Week 7, we'll have 2 chapters, 25, 26. Some of you have worked ahead and you've already done those assignments. Great! That's fantastic. There's nothing stopping you from doing that. Okay, so if you want to work ahead, you're more than welcome to do so. Okay, totally fine with me. If you want to work ahead, great. Knock it out. So next week, a week from today, we'll do chapters 25, 26, and then that's it. Next week is our final lecture. The last day of this class is on December 5. December 5, last day of class. That's the last day of class for everyone. December 5, last day of the semester, really. And then after that, you'll have your final exam. Final exam needs to be completed by December 11th. The final exam, just as it has before in our previous classes, it'll cover the second half of the course. So from week 5, which was chapter 22, all the way through chapter 26 will be covered on the final exam. The final exam consists of 20 questions, mix of true, false, multiple choice. Guess what? No math questions. No formula questions, no math-driven questions on the final exam. The vast majority of them are definition-based. Okay. So
Excuse me, Professor.
Yes, ma'am. Alexis.
One quick question. For the essay questions that are due Sunday, do we have to reply to the students or no? We just
all you gotta do is answer those 5 questions. This is not.
Okay.
It's not a discussion board. It's a short essay type.
Oh, okay.
Yeah, great
All right.
question. Excellent. Thank you for asking. Yep. So I promise you'll all do just fine. Just make sure you do the work, and we'll get through it together. Okay. So without further ado, let's go ahead and jump into today's discussion on performance measurement and responsibility accounting. And I will do my absolute best to provide you with some excellent examples. As always, if you have any questions, comments, concerns, as we're going through the presentation, please feel free to stop me and ask your questions. Just unmute your mic and ask your question, or type it into the chat, or whatever you're comfortable with. I'm sorry. One last thing. As I promised to do, and as I'm doing week 6, I put in some exercises. They're Excel-based exercises. And you're more than welcome to do whatever you like with them, download them, fill them out. They're just practice. It's just practice to help you to better understand the information. I know that some of you have asked for that in the past. And so, I'm doing my best to help you in any way that I can. That's my goal in life, is to do everything I can for you. Okay, let's jump in. Performance measurement and responsibility accounting. This whole thing, this whole chapter, this whole discussion that we're about to have is really about helping us as managers to focus in on accounting data to help us to make decisions. Okay? And when we talk about something like performance measurement, we're looking at the actual performance as it compares to the budgeted performance for each department, for each line item, for each unit that we sell. And we are looking at the performance of each department, each product, etc. So that's performance measurement. And then responsibility accounting really has to do with the responsibility of each department within the company and their ability to responsibly account for what has happened in each department. We'll talk a lot about that as well. So we're going to look at our company in a few different ways. We're going to look at our company, as being individual departments, cost centers, profit centers. I'll talk about this thing called a balanced scorecard, which really measures the entire company's performance. We'll also talk about, we'll talk a little bit about conversion costs. And we're going to look at a couple of different costs. So there are a couple of formulas in this chapter that will certainly be beneficial for you to understand, especially as you complete your homework assignment and as you go through the final exam. But it's good to know how it's used as a manager. That's what I'm trying to get at. And this is all about helping you as a manager to better understand how to analyze your company's performance. For big companies, it is best practice to divide the company into departments, segments, divisions, units, whatever. A big company, think of, let's think of a hotel, okay? Let's say that we're running a Marriott hotel, and it's a big one. It's one of the biggest hotels in DC, okay? Biggest hotels in the district. It's a Marriott. It's downtown. A lot of rooms, okay? We also have a restaurant. We also have banquet space. We also have a convention space. We also have, you name it, right? Pretty much all, let's just say it's got all the bells and whistles, all right? So we have this huge hotel. For big companies like that hotel in the district, in downtown, it's best to manage that hotel by dividing it into departments or segments or divisions, or sometimes all of those, right? Like, for example, food and beverage could be its own division. In most cases in a hotel, it is its own division. Why is it a division? Because food and beverage, we have overseas the banquet space, the convention center, the restaurants, the weddings, etc. So food and not to mention room service. So food and beverage division has departments or segments within that division. So the food and beverage also has a department for banquets, a department for convention, a department for restaurant, a department for room service. You see what I'm saying? You have the hotel as a whole, okay? Then you have divisions. The food and beverage division, within that division, it has these departments, okay? For a large organization like that, that type of organization makes sense. You got the hotel itself, which represents the whole company. And then within that, you have divisions. And then within the divisions, you have departments. That's typically the way a large hotel like that would be designed or organized. Now, the other interesting thing is that Marriott hotel that we just talked about reports to the corporate office for Marriott in Bethesda, Maryland. So Marriott headquarters, Bethesda, Maryland, and we have hotels all over the world, right? We're talking about one hotel in the district in downtown, all right? So that hotel in the district downtown reports back to the corporate office in Bethesda, Maryland. So I want you to think about that organization. There's a lot of different hotels that Marriott has, and they all report back to Bethesda, Maryland. Those individual hotels, they make their own decisions. They manage their own hotels. Bethesda ain't telling them to do nothing. Okay. The headquarters for Marriott in Bethesda, all they're saying is, hey, hotels around the world, just report to me how you're doing every so often. Other than that, you run your own show. You know your hotel better than we do. Sure, makes sense. So our hotel in downtown district, we are a decentralized organization. We make our own decisions at the hotel level. Bethesda don't tell us nothing. We make our own decisions. That's called a decentralized organization. A decentralized organization is where the unit level makes their own decisions without having to make those decisions at the top. All right.
Professor,
Yes, please.
I'm sorry to interrupt.
It's okay.
But wouldn't headquarters be the ones who set the actual corporate strategies? 10, 20 years, this is where we want to be. This is how we want to do it.
Sure,
but then
yeah.
But then that's when the other hotels throughout the world, they come up with their own way as to how they're going to go about doing it.
Yeah, absolutely. Yeah, yeah, yeah.
Okay.
You're right. And and another way to think about it, Lynette, is at the corporate office, they'll set a lot of standards. They'll give you operating procedures. They'll give you other corporate guidance about the brand. They'll give you the structures, but it's up to the hotels to execute on those structures. And the hotel is still going to make their own decisions. Like, for example, at the hotel, the unit level, they'll make a decision about purchasing linens for the guest rooms. They don't need to run that decision through the corporate office. The corporate office doesn't care about them purchasing linens at one hotel. So the hotel makes that decision. That's what makes it decentralized. From an operations perspective, the hotel's making the decisions, not the corporate office. The corporate office tells them, hey, here are your goals, here are your operating procedures, your policies, etc. You just operate based on that. But at the unit level, at the hotel, they're the ones making decisions about the operation. They're the ones saying, I need to purchase these kind of linens. I need to purchase this kind of china. I need to invest more in my sales strategies. I need to invest more in my, I need to do my renovations. The hotel's making that decisions, not the corporate office. Corporate office just giving them the structure to do it.
Okay, because I was becoming a little confused. I was starting to think that now each Marriott set up their own strategic plan and go about.
To some degree, they do. To some degree, they do because they operate in their own markets, right? They know their market way better than the corporate office does.
Can I say something, Professor?
Okay, I get it.
Awesome, cool. Alexis, yes.
Yeah, because even though everyone, you have the franchisees and franchisors, they still make their own. They just have to make the place look accountable for what the standards that the hotel gave them.
Exactly right. That's exactly right, because the vast majority of hotels around the world are franchise operated. And they are still required to operate by the guidelines provided to them from the corporate office. They just have to make sure that they abide by that in a responsible way. But regardless, they're going to go about it how they're going to go about it. You know what I mean? From an operations perspective. But from a reporting structure, they still have to report back to corporate office. Okay, this is what we did. This is how we executed it. But it's not. It's very decentralized from that perspective. Excellent conversation. But yes, that's exactly how it works. And that's how it does work for most hotel organizations. Most restaurants operate that way as well. Even McDonald's, that is a franchise operation. They only have a few corporate type stores, but for the most part, they're individually owned. They still have certain standards that they uphold based off of what's told to them by corporate, but they're very decentralized. They operate on their own levels. Although that this product is the exact same, it's how they operate is what's different. And the same is for the restaurant industry, hotel industry, the auto dealership industry, same exact thing. For example, in the DC area, we have a couple of car dealerships with the same name, right? There's a bunch of them. Heritage, which has a whole bunch of different brands. Coons, they have a whole bunch of different brands. So forth and so on. But they have a similar structure. It's decentralized. Each dealership has their own way about going about selling the cars. The corporate office just provides them with a name. They provide them with the brand, the advertising, branding, all that jazz. But operational wise, they do what they need to do to get the car sold. So that's decentralized. That's what decentralized means. The decisions are made at the unit level instead of at the top corporate level. Yep. And the way that it's structured, we have what's called cost centers, profit centers, and investment centers. Think of these as departments. I have cost centers at a hotel. A cost center are things that cost the company money. These would be things like housekeeping. It would be things like the engineering department, the accounting office, human resources. All of these are cost centers. They're used to help the company to generate revenue, but they cost the company revenue. Okay? They're expenses. They're cost center. They are evaluated from management on their ability to control costs. Human resources is tasked with controlling the cost of labor. How do they do that? They have a budget for the amount of people that they need, and they multiply that by the amount of hours worked. People, amount of hours that need to be worked, and the hourly wages. Human resources is tasked with controlling those things. They need to control those types of costs. The accounting office is charged with controlling the cost of other expenses. The housekeeping department is charged with controlling the costs of what's in their realm, like the cost of linens, the cost of toiletries, the cost of, etc., cleaning supplies. Those are controllable costs within the housekeeping department. So these cost centers, they're tasked with controlling the costs in their respective areas. That's why we call them cost centers. They control the costs within their respective areas, their respective departments. And that's how those parts are organized. Then we have what we call profit centers. And of course, they're tasked with generating income. The profit centers, and using our example of the hotels, a profit center in a hotel, that's the sales department. That's the front office. That is banquets. That is conferences. Those are profit centers. Why are they profits? That's rooms division. Why are they profit centers? They're profit centers because they're tasked with generating income. The sales department generates income. How do they do that? They sell rooms. They sell room nights. They sell event space. They sell banquets. They sell whatever. You see where I'm going with this. The sales department is considered to be a profit center because their task is to help the hotel to generate income. So, if it helps to generate income, it's called a profit center. If it helps to control costs, it's called a cost center. There's a third type of center.
One more time, Professor.
One more time. Cost centers are designed to help to control costs. That would be like human resources, accounting,
Call center control costs, right?
control costs. They're operating within the budget.
Control the name of it is right. Okay.
Exactly, controlling costs. Yeah. The profit centers, that's like the sales department. They help to generate the revenue, helping the money come in. Yeah. So if it's a cost center, they're helping to control costs. If it's a profit center, they're helping to generate revenue. And the third one is called an investment center. An investment center, they are evaluated on the use of assets to generate income. Now, this is a little bit different, okay? In the manufacturing world, an investment center would include the assembly department. It would include the assembly, preparation, whatever you want to call it. They use assets to generate income. The assets being the machinery, the building, etc. In the hotel, the investment center would be the building itself. That's the asset. It helps to generate income. The building itself. Other assets would be things like cash management. So the cash office would be an investment center.
Professor,
Assets.
question.
Marina, yes.
Does that also include like they're the ones that have the role of like where the buildings are going to be established?
Yeah. Yeah.
Okay.
That's where those types of individuals would live, be an investment center. Yeah, absolutely. Good question. Yeah, so we think property, plant, and equipment. Property, plant, and equipment. Those are fixed assets. They help us to generate income. Those property, pretty much anything involved with property, plant, and equipment, those would fall under investment center. Excellent questions. So now that we know our centers, cost centers, profit centers, investment centers, now we're going to take a look at the accounting side of things for those centers. First, we need to know our costs. Now, you guys already know costs. We've been talking about costs for the past 5 weeks. There are two types of costs that all costs fall within. We have controllable costs and uncontrollable costs. Controllable costs are those costs that we have the ability to influence. We have the ability to affect those costs as managers. Yeah. I can control most of my costs at the hotel. Most costs. Not all, but most. I can control the amount that I spend on labor. I can control the amount that I spend on materials. I can control the amount, to some degree, that I spend on overhead. Yeah, I can control those things. And even the managers can control the cost within their departments. The front office, the front desk, they can control the amount of supplies that they use. The sales department, they can control the amount that they spend on advertising. The rooms division, they can control how much they're spending on new linens. Food and beverage, they can control how much, to some degree, that they're spending on food and beverage, right? But there are some costs that they cannot control, that is outside their realm. Now, and I'm going to use the hotel again as an example. We got that hotel in the district downtown. So that big Marriott hotel. There are some costs that they cannot control. Well, think of it this way. They're a franchise hotel. Well, I think they're a franchise. They might be corporate. They're a franchise hotel. They have to pay franchise fees to Marriott. Okay? I don't know if we talked too much about franchises, but I'll tell you this. So with franchises, the way it works is the franchise purchases the rights to use the name of the brand. Yes, they're paying for the brand, exactly. That's what paying a franchise fee is. So if I'm a Marriott hotel and I'm just this guy that owns a Marriott hotel, right? I have to pay Marriott for the right to use their name on my building. I have to pay them for every reservation I make, some small percentage, because I am using their reservation system that they gave me. Okay. Those costs I cannot control. Those costs are set by the corporate office. But my hotel, I have zero control over what those costs are going to be. Marriott tells me, okay, hey, Dr. B, with your hotel you got downtown, your franchise fees are 3% per reservation. Okay. I don't know how many reservations I'm going to have, but I know that my fee's 3%. I can't control that 3%. I got to pay them the 3% regardless. Okay? They set the price, not me. So I can't control that cost. Cannot control that cost. Some salaries I cannot control. Some of those salaries might be dictated to me. Go ahead, Marina.
I have a quick question. When it comes to like sponsorships, is that something that it cannot be controlled? It's controlled by the higher ups. Like they have to get approval before they can sponsor anything.
Sometimes, yeah. It depends on the relationship and the organization, but that's a great question. So there are some other costs that they cannot control. If Marriott decides to run a TV ad, and it's for all Marriott hotels around the world, the franchisees, the individual hotels, they cannot control that. They still have to pay Marriott for that, though. So when it comes to types of sponsorships, it depends in the relationship. But for the most part, the answer is no. They cannot control those costs. They have to pay them regardless. That's something not within their realm.
That's where headquarters and but that they make those decisions as to who they want to be affiliation with in returns to the company, right?
Correct. Yep. And those types of decisions are made at the corporate level. So that would be an uncontrollable cost. Because the managers are only concerned about managing the cost at their hotel. But if it's something that happens above them at the corporate level, that's an uncontrollable cost. Great question.
Okay.
Yep. Excellent question. So yeah, so for that type of relationship, it depends. Okay. So we talked about the costs. We talked about cost centers, profit centers, investment centers. We talked about controllable costs and uncontrollable costs. Now we need to talk about how do we account for all that stuff? How do we account for it? Well, we use an accounting system, of course. But what type of information does that accounting system tell me? Because obviously I need to be able to control as many costs as I can. But I also need to be doing it in a responsible way. So I use this thing called a responsibility accounting system. And what this is my accounting system tells me information on how I'm managing my costs that are controllable. And it also tells me how responsibilities of individual managers relate to that information. In other words, how well are my individual department managers managing their respective costs? How well is my cost center managers managing their costs? How well are my profit center managers managing their costs? I can relate that information to either the individual managers or to the entire organization. How do I do that? I take my budget that we talked about in previous chapters, take my budget, and I compare my actual performance to my budgeted performance. And what that tells me is how well I'm doing. And I use that information to evaluate my performance. The entire organization, entire company, ultimately is responsible for the accounting and managing costs at all levels of management. Even the corporate office, to some degree, has some responsibility in the accounting. This graphic representation shows us, to some degree, the accounting process. We have our individual departments at the bottom. We got food and beverage, service, etc., etc., etc. All of those are within a hotel. And then it goes from the hotel level to the regional level to the country level to the world level, which is the president and board of directors. Responsibility accounting ultimately starts with the bottom. It starts with the department managers. And it goes all the way up to the global level. I mean, it reports all the way up to the board of directors. Who's responsible to the board of directors? Well, the president is. Who's responsible to the president? The vice presidents are. Who's responsible to the vice presidents? The regional presidents. Who's responsible to them? The hotel managers. Who's responsible to the hotel managers? The department managers. Who's responsible to the department managers? The individual employees. So this is an example of a corporate structure that shows us the path of responsibility. Who's responsible for controlling costs? Ultimately, it starts with the departments and goes its way up. Okay, so there's a couple of reports that management looks at to really understand their overall performance. We call these responsibility accounting performance reports. What a fancy name, right? These reports tell us the amount of detail in the organization based off of line items that I'm most interested in. What does that mean? Think of your income statement. We have revenues, cost of goods sold, gross profit, expenses, net income. Okay? That's your income statement. You could technically, you can have an income statement for each department. You add them all together, that's for the whole company, right? But each department manager is responsible for managing their expenses, their costs. Each department manager would be interested and looking at detailed reports for their department to manage their respective costs. I'm going to give you another example. This one's from retail, okay? I'll give you a retail example. Let's say you're a retail store manager. You're a department manager within a store. Let's say it's Macy's. I like Macy's. It's one of my favorite companies. I don't know why. I haven't shopped at a Macy's in years. But okay, I like them. Okay, they have a nice operation. That's why I like them. Let's say you're a jewelry department manager at Macy's. Okay? So your responsibility is for managing the costs of everything that happens in your jewelry department. You're the department manager for the Macy's jewelry department. Okay? So you would be interested in knowing exactly how well each line of jewelry is performing. How are my ring sales? How are my necklace sales? How are my earring sales? Etc. Right? How's my costume jewelry doing? Etc. You're interested in knowing how well each line of jewelry is performing. You're also going to be interested in managing your costs for your jewelry department. For example, how well am I managing my labor expense, my hourly employees, my salespeople at the jewelry department? Are the amount of hours that they're working matching the amount of revenue that I'm taking in? How well am I managing my supplies expenses, my costs for my department? Those are all controllable for the jewelry manager of the jewelry department at Macy's. But you're going to be most interested in the detail, yeah? Because you're managing your department, you want to be the best damn department manager you can be, so you want to make sure that you're able to identify all the costs for your department. But this store manager don't care about that. No. The store manager is interested in looking at a summarized report. Summary. What was jewelry department's income and what were their expenses? That's what the store manager cares about. The store manager isn't going to look at the detailed line items. The department manager is going to look at the detailed line items. The store manager, they're just looking for a summary for each department within the store. Make sense? Best way to think about it is that the department that is closest to the customer are the ones that should care most about the information for their departments. The store manager who ultimately oversees all the department managers, they're at the higher level, so they're going to receive less detailed information. Okay. So we have a couple of different departments for our hotels. This is some information. Don't exactly know what type of company this is, but I'm going to say it's a hotel company because I see some food and beverage and service. So with the responsibility accounting as a result of performance reports, the managers here at the very bottom, the managers of each department are concerned with materials, labor, overhead, expenses, costs. Why are they concerned with those costs? Because they can control them. I can control the amount of, if I'm a beverage division manager, department manager, I can manage the amount of beverages I have, my inventory. I can manage the amount of labor I'm using in my department. I can manage, to some degree, the amount of overhead for my department. I can control those costs. So each department manager is concerned with looking at the direct materials, direct labor, and factory overhead for their department. So they manage those controllable costs, right? The vice president of that region is going to look at that information, but as one line item, beverage department, right? Just beverage department. Why is that? Because the vice president is also responsible for their costs. Salaries for all department managers, depreciation, insurance, and then the total cost, beverage, food, service. See how it condenses down to one line item when it goes a level up. Same concept applies for the hotel business, the retail business, whatever business. For big organizations like this, a global enterprise, it's a line item. It's a line item. It's a line item. At the bottom, it's very detailed. Closest to the customer, most detail. Direct materials, direct labor, factory overhead. Add all those things together, that the department manager is concerned about those costs. The manager above the department, like the hotel manager or the store manager, that's one line item. The beverage department's one line item. Because the hotel manager, they also have food department, service department, etc. But they also have the other store-related costs or the hotel-related costs. And then when it goes above the hotel to the corporate office sees a very small detail of the hotel's performance. And that is a part of the region. It goes to the region. Right? But you see what happens, right? It's the level of detail at each level. The department managers, they get the most detail. The hotel or the store manager, they get a little bit of detail. The division or the regional managers, they get a little bit of detail. And the vice at the highest level, very little detail. But you see how it all gets condensed, right? That's how responsibility accounting flows. So the unit or the department, most amount of detail. And then it gets less and less as it goes up the chain. But we see how it flows, right? The totals from the department go to the region. The total from the region goes to the corporate office. And then everything gets totaled up. It all rolls up. Now, we talked about our cost centers. We talked about our profit centers. We talked about our investment centers. And we talked about the reporting. Now, I had mentioned that it's important to understand the difference between controllable costs and uncontrollable costs. Controllable costs are the costs that the managers can control. It's within their realm. Uncontrollable costs are costs that are kind of top down, that come down from the corporate office, and they're costs that they cannot be controlled at the local level. It's also very important to understand the difference between direct and indirect expenses as they relate to each department. Go ahead, David.
Hey, Professor, you know how you use McDonald's as an example of the franchise?
Yes.
And how they run their own show basically, but they do listen to someone.
Yes.
So for example, say like the cheeseburger.
Uh-huh.
I know for a fact that McDonald's cannot take the cheeseburger off their menu.
Correct.
That's like above the manager's level.
That's at the corporate level.
Right.
Yep.
That got to stay on the menu. But what about the price of the cheeseburger?
The price could be dictated by the local store.
By the local store? Okay.
Yep. So
Okay.
that's something within the control of the local store. The reason for that, David, is because if you think about McDonald's on a national scale,
Right.
the cost of that cheeseburger is going to be a lot higher in New York City than it is going to be somewhere in Wisconsin, for example.
Exactly.
Okay. Or it'll be a lot higher in D.C. than it will be in the rural area of Florida. Okay.
Right.
So the local stores have some control over the price that they charge.
But they can't.
for that.
But they can't. They can't go overboard with it. Say, they want to just say stump all their competitors and drop their cheeseburgers to a quarter.
No, it's not possible.
I mean, because of what you have to pay to buy it.
They probably have to run that type of decision past the corporate office. But
Right.
because there's a certain range that they probably have to stay within.
Okay, I get what you're saying.
That's why you see the commercial at the bottom of the commercial. It says participating restaurants only for certain like promotions. You know what I mean?
Mm-hmm.
The
Yeah.
dollar menu that don't
Pop-
exist, the dollar menu don't exist in New York City. Okay,
Right.
it does exist outside of New York City. So participating restaurants only. That little saying gives the restaurant the authority to have their say over the prices. But it has to be within range. It has to like they can't go below a certain amount, and they probably can't go above a certain amount. Yeah, good question. Good question. So let's talk about the expenses and how they are allocated to the departments. So we talked about controllable expenses and uncontrollable expenses. Controllable expenses are the ones that the managers can control, and the uncontrollable ones are outside of the manager's realm. So in understanding how that works, there are direct expenses and indirect expenses. And we allocate these expenses to the departments in a certain way. Direct expenses are the expenses that can be traced directly to the department and incurred for that department's sole benefit. In other words, I talked about Macy's and the jewelry department. There are expenses that I can track directly to that department in Macy's store. An example, I can directly trace the cost of each piece of jewelry that is currently available for sale in the jewelry department. I know how much every ring costs, every bracelet costs, necklace costs, costume jewelry costs. I know those costs. I can trace those costs directly to the jewelry department. Why? They're not sold anywhere else. They're not going to be sold in the men's department, men's clothing department. They're going to be sold in the jewelry department. So I can directly trace the cost of the jewelry to the jewelry department because it's a benefit to that department. That's called a direct expense. I can directly trace it to that department. I also have these indirect expenses that are associated with the jewelry department. Indirect expenses, as you would think, are expenses that I cannot directly trace to the department for the department's benefit. So I go about allocating those expenses to that department in a way that makes sense. So let's take a look at these indirect expenses. I got wages and salaries, rent, utilities, advertising, and depreciation. That's a lot. It is very difficult for me to directly trace the manager's salary to that department to some degree. let me put it this way. For a department manager, they spend about 90% of their time in the department. About 10% of their time not in the department, but in store level meetings or store related activities, like stocking other departments before the holidays. I can track wages and salaries to the jewelry department based on the amount of hours worked in the department. So that my allocation base for wages and salaries is going to be based on the number of hours for that department. I can allocate a portion of the rent for the whole store to the jewelry department. It's based off of the square feet of space that the jewelry department occupies. So if I have a 500,000 square foot store, it's a pretty big Macy's, and my jewelry department makes up 5,000 square feet of that 500,000 square foot store, and my rent is $1 million a month, I can allocate the portion of the rent to the jewelry department based on the square footage. How do I do that? If my rent is $1 million a month for my Macy's store downtown, so $1 million divided by the total square footage. If the square foot of my whole store is 500,000 square feet, that gets me a total of $2 per square foot. Okay? So $2 per square foot times the 5,000 square feet of my jewelry department. That means per month, I can allocate a total of $10,000 per month of rent expense to the jewelry department. Make sense so far? Y'all with me? You good so far, yeah? Everyone understands that concept?
Yeah, we're good.
Yes.
Great. So I took the total amount of rent for the month, divided by the total square footage for the whole store. I got $2 a square foot. I multiply that $2 per square foot times the amount of square foot for the jewelry department. In this example, 5,000. Gives me a total rent for the month for the jewelry department of $10,000. I do the same thing with utilities. I take my utility bill for electric, divide it by the square footage for the whole store, multiply it by the square footage of the jewelry department, and that is the utility expense for the jewelry department. To some degree, that makes sense. Advertising. I can allocate a percentage of sales that the jewelry department makes for the advertising expense for the store. And for depreciation, I can allocate depreciation expense based off the hours of depreciable asset used. So if my jewelry department uses the jewelry display cases for X amount of hours per month, that will be my allocation for depreciation expense. So direct expenses, I can directly trace them to the department for the benefit of that department. Indirect expenses, I cannot trace it to one department, but I can allocate it to that department based off of that department's data. For example, for rent, if it's $1 million a month for rent for 500,000 square feet for the whole store, the jewelry department takes up 5,000 square feet. That's $2 a square foot per month. $2 a square foot per month times the 5,000. That's $10,000 per month for the jewelry department for rent. That's how you would allocate it indirectly to that department. It's very similar to when we talked about activity-based cost. Very similar. Very similar. Typically, we allocate expenses based on the indirect method, the indirect process. Indirect and service department expenses are allocated across departments that benefit from them. The formula is very straightforward. We take the total cost to allocate times the percentage of the allocation base. The total allocated cost, we take the total cost to allocate times the percentage of the allocation base. Base used, I guess. What about service departments? Service departments, as you know, are the departments that assist the entire operation. Be like the office, human resources, accounting. Those are all support. They're support services for the whole store, right? Or for the whole company. Even at the hotel has human resources, payroll, accounting, engineering. They're all support. Engineering is maintenance, yeah. They're all support departments. We call them service departments. They support the operations. They service the operations. I can allocate the expense of those service departments to the departments within the store. I can allocate the expenses of the service departments to the departments within the store. For example, the payroll office within the accounting office, I can allocate a portion of that expense, the payroll expense, meaning the processing fees for the paychecks, to that department. And it's based on the number of employees in that department. So at Macy's, I have 5 employees that work in the jewelry department. They're hourly employees. I can allocate a portion of the payroll expenses to that jewelry department based on the 5 employees that work in that department. Basically, it's like assigning the cost, right? I'm assigning a portion of the cost to that department through that process. Because all departments within the store, they share the expense of the accounting office, the human resources office, the back office, the maintenance office. They share those expenses. So I need to allocate the expenses based on their usage. What's the usage? It's the number of employees in each department. That's the usage base. For wages and salaries, it's based off of the hours worked in each department. For rent, it's the space occupied. For utilities, it's the space occupied. For advertising, it's percentage of sales. For depreciation, it's the assets used. For the service departments, it's the number of employees in the departments. It's the For purchasing, it's the amount of the purchase orders processed. For maintenance, it's the square footage. Those are the allocation bases. That's how I allocate the expenses from the service departments to each department. The jewelry department. Okay. My jewelry department. I knew there's a jewelry department example. Did I? I don't know. My jewelry department. I have a jewelry department, and I pay $800 per month. Oh, I'm sorry. I have a store. The store. It's a jewelry store, by the way. The store pays to have the store cleaned $800 per month. A team of people comes in from another company. They come in and they clean my store. They do it in the overnight hours. Yep. The management allocates this cost to the 3 departments that it has based on their floor space. The jewelry department has 2,400 square feet of the store. The total store is 4,000 square feet. The jewelry department has 2,400 square feet of that space. So 2,400 square feet divided by the 4,000 square feet, that's 60%. The jewelry department makes up 60% of the entire store. Therefore, I will allocate $480 of the cleaning service to the jewelry department. How did I come up with that amount? 800 times 60% is 480. My watch repair department is 600 square feet. That's 15% of the total store. 600 divided by 4,000. I will allocate $120 of the cleaning service to the watch repair department. How is that? 15% of 800 is a 120. China and silver department makes up 1,000 square feet of my store. That's 25% of the total store. I'll allocate $200. How is that? 25% of 800 is 200. Everyone sees how we do this? It makes sense, right? Y'all kind of get why we do it this way? Maria?
Yes.
Yeah, thank you. Great. Once we've figured out the costs, direct costs, indirect costs, we can prepare the income statements, contribution reports. Earlier, I had said that as a manager, I like to look at each department as its own income statement because the departments, they generate revenue and they generate expenses. And having those line items for each department helps me as a manager to be able to control my cost and to help to generate more revenue. So I allocate revenue and expenses based off of their direct and indirect expenses. I allocate the indirect expenses for both service and operating departments. I do it for each department. I allocate the direct and indirect expenses. I prepare department income statements. Each department has an income statement. My service departments don't generate revenue. My human resources people, they're not selling stuff. Okay? So human resources, they don't generate a revenue. They're an expense department. My accounting office, they don't generate revenue. So there are no sales for the accounting office. My maintenance department, they don't generate sales. They're maintenance, right? So I'll allocate the direct expenses for those departments. Salaries, depreciation, supplies. And to some degree, rent, utilities, insurance. My other departments that generate sales, I'll have sales for each department, cost of goods sold for each department, salaries, depreciation, and supplies. Those are all my direct expenses. So that's step one. I find and allocate all of my sales and direct expenses for all of my departments. My service departments, of course, they're not going to have sales, but my operating departments will. So at my operating departments for Macy's, I got the jewelry department, the clothing departments, housewares, appliances, etc. This goes on and on. I have sales for each department. I have cost of goods sold for each department. Salaries, depreciation, supplies. Those are all my direct expenses. So I allocated my sales and direct expenses for all my departments. Then what I need to do is allocate my indirect expenses to each department. How do I do that? Well, it's based off of the total expense divided by whatever it is. Floor space, sale, a percentage of sales, use of assets, etc. And then I also allocate my service department expenses to my other departments based off of their usage, of course. Number of employees, purchase order numbers, etc. This is the process of allocating. Then I could generate my total income statements for each department. My sales minus cost of goods sold equals gross profit minus my direct expenses and minus my indirect expenses that have been allocated minus my allocated service department expenses equals total operating expenses. My gross profit minus my total operating expenses equals my operating income or loss. And I do it for each department, right? In this example, I got hardware, housewares, appliances, or it could be, if it's Macy's, jewelry department, housewares, appliances, clothing department, etc. I add all those together to get my combined income statement or my total income statement for the whole store. It's kind of a nice process. I do like the allocations. I think it's somewhat interesting because as a department manager, if you're a department manager now or you might be at some point in the future, and you're, whether it be a retail store or a hotel or whatever it is you plan on doing, even in a restaurant, you will have to allocate expenses for the whole store or the whole unit to each department to really get a good understanding of this thing called departmental contribution. Departmental contributions are important to understand because it helps us to evaluate the performance of the department as a whole. It helps us to identify the expenses that have been allocated to that department that may not be necessarily used by that department, but are important to share in the expense. So it's a very straightforward formula. It's the revenue for the department minus direct expenses. Department revenue minus direct expenses for the department equals departmental contribution to overhead. Why is it important to understand the allocation of overhead? Because if a department has a negative contribution, it may be important to eliminate that department. So think of a store. Think of Macy's, for example. Some departments don't always make that whole lot of money. Their revenue might not be so great all the time. And when that happens, the company, the store, might decide, you know what? Maybe we should stop selling this year. Like, for example, my favorite example, mattresses. Macy's used to be, they tried to sell them. A long time ago, Macy's is really best known for their clothing. They're best known as a clothing retailer. They sold clothing, jewelry, toys, appliances to some degree, home appliances, small appliances. They used to sell, some stores might still sell them. They used to sell mattresses and furniture. It was kind of a, one shop all type place. So a couple of years ago, Macy's started looking at this report, the contribution to overhead for each store, and saying, hey, our mattresses, we have a negative contribution sometimes to the store. Well, maybe it's time to stop selling the mattresses at our store. It's losing us money. That's why it's so important to understand this. And that's why you've all seen it at some point. Maybe you didn't realize it. You go to some of these stores, it's like, oh, what happened to that department? It's gone. This is why. That's why that happens. Sales minus cost of goods sold equals gross profit minus your direct expenses gets you your departmental contribution to overhead. Departmental contribution to overhead minus the indirect expenses is total net income for the whole company. That's why we look at it that way. We analyze each department. We want to eliminate the ones that are not profitable. Or figure out a way to better control their costs. Investment centers. So we talked about the cost centers. We talked about the profit centers. We briefly talked about investment centers. Well, let's do a little bit of a deeper dive on investment centers. I had mentioned that it's important to look at investment centers as property, plant, and equipment, your fixed assets, that help to contribute to generate revenue, right? How do I measure my property, plant, and equipment to generate revenue? There's a couple of different ways I need to look at property, plant, and equipment that are used to generate revenue. The first is called the return on the investment. I purchased that piece of equipment. Now I need to know how much revenue that piece of equipment is earning me. Return on investment. How quickly can I pay that piece of equipment off? And how quickly it is able to, or how much revenue is it generating me? Return on investment. Residual income. After the expenses to operate that piece of equipment, how much additional income is it earning me? Profit margin. Profit margin, you guys know the profit margin. We talked a lot about profit margin. Profit margin, I'm looking at how much profit these fixed assets are earning. An investment turnover. After I've received my initial investment back, how quickly can I reinvest it? Investment turnover. So ROI, return on investment. With ROI, we take the investment center income, that's the income we've earned from our property, plant, and equipment, divided by the investment center average of invested assets. That one's a little bit more complex to understand, so let me walk you through it. Here's an example. We have a company that sells electronics. Within a division, within our electronics company, we have two divisions. We have phones and we have televisions. Within there, we have a couple of different components, but LCD televisions, phones. Okay. Investment center income for LCD TVs, $526,500. For phones, $417,600. The average invested assets. The average invested assets are the average of the assets used in the investment center. So property, plant, and equipment total, right? That's your average invested assets. So the formula is the investment center income divided by investment center average invested assets. In the example of our television, $526,500 divided by $2.5 million, that's 21% ROI. For the phones, it's 23%, $417,600 divided by $1.850 million. 23%. In looking at this information of ROI, as a manager, I can make a decision whether to continue selling that product or not. It's also important for management to understand what the residual income is. The residual income is where I take my net income from my investment center and I subtract the target investment center net income. It's called residual. It's the additional revenue, right? Additional, residual. So income minus my target income equals my investment center income. Target income is typically based off of a percentage of total assets. In this example, it's 8%. Understanding the investment turnover, also important. Investment turnover helps us to better understand the utilization of our fixed assets, property, plant, equipment. Looking at ROI from that perspective, I would take the profit margin times the investment turnover. How do we find the investment turnover? We have the investment center income divided by the investment center sales times, should be a time sign there, times the investment center sales divided by the investment center average assets. So profit margin is broken out by income divided by sales. Investment turnover is investment center sales divided by investment center average assets. This one's important. I want you to understand this one. This is called a balanced scorecard. A lot of companies use this. For those of you hospitality majors out there, you know this one. To some degree, you know this one. In the hotel world, we have this thing called a STARS report. The STARS report tells us basically the guest satisfaction based off a couple of different metrics, right? Cleanliness of the hotel, friendliness of the front desk staff, how quickly their check-in and check-out process went, average room nights, visits to the hotel food and beverage, etc. The STARS report basically tells us a lot about the guest satisfaction. Yep. That is a part of the balanced scorecard, be under customer, guest. A lot of companies use this type of information to really better understand their business as a whole. We put together financial and non-financial information together to best understand the entire perspective of the company. From customers, I look at satisfaction ratings, number of new customers, percentage of on time, percentage of new products sold, time to fill orders, percentage of sales return, looking at all the customer data. Okay. In the hotel business, it's like check-in, check-out process, times visited to food and beverage, friendliness of the front desk staff, et cetera, et cetera. Companies also look at the internal processes. Internal processes are best to understand based off what happens at each step of the process within the company. This example, it's an auto manufacturer. We look at things like defect rates, cycle time, product costs, labor hours, production days without an accident. In the hotel business, it might be something like food and beverage costs, linen costs, labor hours worked per department, sick time used, etc. These are all internal pieces of information used to better understand the performance of the company. The third area we look at is called innovation and learning, research and development, training for our staff, etc. We look at things like employee satisfaction, employee turnover rate, the amount spent on new training, amount of new products, new patents, the amount spent on research. And then to sum it all up, we also look at financial results. Be things like net income, return on investment, sales growth, cash flow, residual income, stock price. We look at all four of these pieces of information to understand the total performance of our company, how well we're doing. That's why it's called a balanced scorecard. It includes financial and non-financial information together. It's the whole picture. I like the balanced scorecard. It's a nice piece of information for management. Okay. We talked about cost centers. We talked about profit centers. We talked about investment centers. We talked about departments, regions, etc. Now I want to talk to you about this thing called transfer pricing specifically. Transfers is when I transfer product from one store to another. For example, let's say we're Macy's. We have the jewelry department at Macy's. And you're a manager of a jewelry department at Macy's. You get a phone call from a store that's in another region. Let's say you're here in the district and you get a call from a store that is in California, in Los Angeles. They say, hey, I'm totally out of this inventory. I don't have the capacity to get more. We need to transfer some of the jewelry from DC to LA. Okay. There is cost associated with transferring inventory from one region to another. Let's explore that concept. The store can simply go to the manufacturer and have more units produced, or they can have additional inventory transferred from one store to another. Typically, with an organization like Macy's, there's usually like a central warehouse. If that central warehouse is out, then we would do a store-to-store transfer. Very common practice in retail. In manufacturing, it's somewhat similar. Our electronics business, we sell TVs and phones, etc. We do transfer from one division to another. I can transfer capacity from one division to another. Capacity is the amount that we can produce, right? That's capacity. You got sales price, variable cost of manufacturing, and fixed costs of manufacturing. I currently sell each unit for $80 a piece. I have a total variable cost per unit of $40 per piece. I can transfer some units to another division, or I can purchase the product from another company. How do we make that type of decision? Well, it's based off of the which one will be the lowest cost. Sometimes it's cheaper to purchase it from another company than it is to manufacture more of it, especially if they're at capacity or if they don't have the ability to transfer it. Transfer prices are typically negotiated between the two division managers, and it's a price that is agreed upon between the two division managers or set by corporate. But there's always a cost associated with transfer. It's also important for management to understand the cash that we have on hand. Even for each department, to understand the amount of cash. Why? Because we might need to purchase more inventory. It's important to understand the relationship between cash and inventory because there will be certain points in your management career that you may need to purchase more inventory or sell more inventory. And the only way to do that is with cash. So there's a couple of different formulas you need to understand. The most important one is called the cash conversion cycle. The cash conversion cycle is computed by taking the day sales and accounts receivable plus the day sales and inventory minus the day sales and accounts payable. I can hear you already. What is day sales and anything? Well, it's really three different formulas in one. Day sales, accounts receivable. You take accounts receivable divided by net sales times 365. Days sales. There's 365 days in a year. Day sales. Day sales and inventory. It's total inventory divided by cost of goods sold times 365. Day sales and accounts payable. It's total accounts payable divided by cost of goods sold times 365. Day sales accounts receivable plus day sales and inventory minus day sales and accounts payable. how long it takes to get the cash coming in and out from your customers. That's the whole point of the conversion cycle. Gives you an average. It's used to some degree. It's used in the real life practicality of things, but not always that easy. When we talked about cost allocations earlier, there's of course a formula involved. And we talked about this. Well, how do we figure out how much cost needs to be allocated? We take the total cost to be allocated times the percentage of the allocation base used. The allocation base used is typically square footage. In our example, we have square feet. We have the allocation of assets. And that's how we allocate the percent based on the percent usage. Sorry. Utilities based off of square footage. Square feet for each department divided by total square foot gets me the percent of the total square footage. That's how I allocate the total cost. It's pretty straightforward. Same with advertising. Advertising will be usually a percentage of sales, which makes sense. I'm not gonna allocate advertising expense to the human resources department or to the back office or to the accounting office. They didn't make that expense. Expense comes from departments that actually generate sales. Insurance. It's usually based off of the value of assets, would be the basis. Each department divided by the total gives me the percentage. I take the total cost times that percentage, give me the allocated cost to each department. Service departments, we talked about that. This is just we're just recapping basically what we talked about when we talk about allocation. Number of purchase orders from the purchasing department. Purchasing department, as you know, is a support service department. Purchase orders divided by the total purchase orders gives me the percentage. The total purchase order amounts times the percentage gets me the allocation. Earlier when we talked about transfer pricing, it's an agreement of the amount between the two division managers, department managers, because the cost needs to be covered any time that we're transferring from one department to another. I don't want to lose on a transfer amount. That's just silly. Transfer price should never exceed capacity, and it should never exceed the total cost. The price typically matches whatever the sales price is. When one division produces less than another, the transfer price is typically somewhere in between the total variable cost and the total sales price. And one of the last things we'll talk about is the joint costs. Joint costs, as you know, are costs that are shared across departments based on the support used. For example, our accounting office is shared across all departments. That cost is shared across all departments. It's a joint cost. So each department receives a share of that cost. It's usually based off of like number of employees. Percent basage. It's the same way everything else does. And that, my friends, is the conclusion of our conversation on performance measurement and responsibility accounting. Any questions so far? Anything at all? Y'all good? Okay, let's recap. What is due Sunday night? Why is it important to do it? The homework, Module 3, Week 6. Now remember, it's different. Chapter 24, essay questions. It's not long essay, it's short essay. What does that mean? 1, 2, 3 sentences each. Easy. There are 5 questions. These 5 questions can be very easily answered based off of everything we talked about today, what's in the PowerPoint presentation, and what's in your textbook. What am I looking for exactly? I'm looking for 1 to 3 sentences to answer each question. I want you to use your own words. Don't just copy and paste it from the textbook or from the PowerPoint. I will not like that very much. Please use in your own words. If you decide to quote the textbook or the PowerPoint presentation, please include references, citations. But with that, it is so important that you do this homework assignment. Why? It's worth 10 points. 10. 1-0. How much is 10 points worth? It's worth a full letter grade. Full letter grade. Please make sure you complete this assignment. Don't miss a full letter grade because you decided not to type a couple words. All right? So important that you do this. Don't miss it. 5 questions. Each question is worth 2 points. I'm looking for 1 to 3 sentences per question. That's all. It's easy. It's very, very easy. You're just answering the questions. It's short essay. Not like long. I don't need paragraphs. I just need 1 to 3 sentences per question. That's all. Does it make sense? Any questions on what you need to do?
It makes sense. Thank you, Professor.
Thank you, Marina. Appreciate it. All right, my friends. With that, next week, we will cover the last 2 chapters, 25 and 26. You're more than welcome to work ahead if you'd like to. And in fact, I recommend that you do, just to make life a little easier for you. The last thing you want to do is be jamming a couple of pieces of homework assignments before your final exam week. That's crazy. The final exam will cover week 5, chapter 22, all the way to chapter 26. So 22 to 26 on the final exam. The final exam is covered in the final week, week 8. The final exam consists of 20 questions, a mix of true, false, multiple choice. The vast majority of them are definition-based. There is no formula-driven math questions on the final exam. The final exam is open and available. If you do want to take it now, you're more than welcome to, but it's only one shot on the final exam. So I would recommend that you wait until after we cover chapter 26. And with that, if you need any help, have any questions, please feel free to email me, call me, set up office hours, whatever it takes. I'm here for you 100% of the time. Yes, Alexis. Hi, Alexis.
Thank you, Professor.
It's my pleasure. It's always a
You
pleasure.
enjoy your holiday.
Thank you. You as well. I would like you all to please take care as you go through your Thanksgiving holidays. Enjoy some good food with some good company. And with that, please stay safe. Wash your hands. Do the right things, and I'll see you all again next time. Have a great rest of your day. Thank you all so much. Take care. Bye bye.
Thank you, Professor.
Professor.